Imagine waking up tomorrow to discover that one of the world's biggest banking systems has suddenly told millions of investors they can no longer trade gold the way they always have. No countdown, no major warning, just a deadline, and once it arrives, those familiar paper gold products disappear. At first, it sounds like a routine move to protect everyday investors from market volatility. But what if that's only the explanation on the surface? What if something much larger has been quietly taking shape behind the scenes for years? And what if this isn't really about restricting gold at all, but about reshaping the future of the global financial system? Welcome back to Ag John Silver Update. Today, we're looking beyond the headlines to uncover what China's latest decision could really mean for gold investors, central banks, the US dollar, inflation, and the future of the global economy. By the end of this video, you'll understand why professional investors are paying much closer attention to this story than most mainstream media outlets. Let's dive in. On June 24th, China's largest commercial bank, the Industrial and Commercial Bank of China, better known as ICBC, announced that it would gradually discontinue several paper gold trading products for retail investors. Existing positions would eventually be phased out, and once the transition period ends, new positions through these products will no longer be available. What made this announcement even more interesting was that it didn't remain an isolated case. Within a short period, several other major Chinese banks, including the Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank, either introduced similar restrictions or had already begun scaling back access to comparable paper gold products. Whenever multiple systemically important banks begin moving in the same direction at nearly the same time, experienced investors take notice. Large financial institutions rarely make identical strategic decisions purely by coincidence. Naturally, one question immediately surfaced. Why now? The official explanation seems reasonable enough. Gold has experienced unusually large price swings over the past year. After climbing to record highs, prices pulled back sharply as markets reacted to changing interest rate expectations, geopolitical tensions, and shifting global liquidity. Leveraged retail traders were taking increasingly aggressive positions, exposing themselves to greater financial risk. From the bank's perspective, reducing access to highly leveraged paper gold products could help protect inexperienced investors from severe losses. On the surface, that explanation makes perfect sense. Greater volatility often leads to tighter regulations, and similar measures have been introduced in different financial markets around the world. But here's where the story becomes much more interesting. China is not banning gold ownership. People can still buy physical gold bars. Jewelry stores remain open. Long-term investment in precious metals continues. The restrictions are aimed specifically at certain leveraged paper gold products. That difference is incredibly important. Many investors assume that buying paper gold means they actually own physical bullion. In reality, those are often two very different things. Think of it this way. Imagine there's a rare collectible worth $1,000 locked safely inside a vault. Instead of selling the actual item, certificates representing ownership begin trading between investors. Most buyers never request delivery, they simply trade the certificates. As demand grows, more certificates are created, even though the original collectible never leaves the vault. Soon, dozens of ownership claims exist for a single physical asset. Trading activity explodes, prices fluctuate every day, yet the real item barely moves. That's a simplified picture of how many paper commodity markets operate. These markets provide tremendous liquidity and make trading far more efficient. Futures and other financial contracts allow enormous amounts of gold to change hands without requiring physical bullion to move at all. There is nothing inherently wrong with that system. It serves important purposes. Mining companies hedge production, manufacturers lock in future prices, institutional investors manage risk, and liquid markets help improve price discovery. However, critics have argued for years that paper trading volumes have become so much larger than the available physical metal that prices may sometimes reflect financial speculation more than actual supply and demand. Whether that argument is completely accurate remains open for debate, but it's a discussion that has existed throughout the precious metals market for decades. Now, look again at China's latest decision through that lens. Instead of discouraging physical ownership, regulators appear to be limiting speculative paper trading while leaving physical investment untouched. Is this simply an effort to reduce excessive speculation? Or is it the first visible step in a much larger financial transformation that's only beginning to unfold? Before we explore that bigger possibility, it's worth asking an important question. What have the world's central banks been doing while everyone else has been focused on daily price swings? The answer is surprisingly consistent. Over the last several years, central banks have been buying gold at one of the fastest rates seen in modern history. Public data from international organizations shows that official demand has remained exceptionally strong as governments continue diversifying portions of their reserve assets. That naturally raises another question. Why would institutions that plan decades into the future suddenly become such aggressive buyers? Unlike retail investors, central banks don't chase trends or react to social media headlines. Their responsibility is to protect national reserves, preserve confidence in their currencies, and prepare for economic uncertainty long before it becomes obvious to everyone else. So when dozens of countries quietly increase their gold holdings year after year, professional investors pay attention. Not because every central bank is guaranteed to be right, but because their decisions are usually based on long-term strategic planning rather than short-term market emotions. Every country has its own reasons. Some want to diversify away from foreign currencies. Others are preparing for geopolitical uncertainty or strengthening confidence in their financial systems. Whatever the motivation, the overall trend is becoming increasingly difficult to ignore. China has been following a similar path. For years, it has gradually reduced portions of its U.S. Treasury holdings while continuing to strengthen its domestic financial infrastructure. By itself, that doesn't necessarily signal confrontation. Large reserve managers regularly rebalance their portfolios. But when you combine that trend with rising gold purchases, expanding domestic exchanges, and new settlement initiatives, a broader picture begins to emerge. Here's something many people overlook. If China truly wanted citizens to lose interest in gold, why has it spent years expanding its own physical gold market? The Shanghai Gold Exchange has become one of the world's most important centers for physical bullion trading. Chinese consumers remain among the largest buyers of gold jewelry and investment bars anywhere on the planet. Physical demand continues to remain strong. None of that looks like a country trying to eliminate gold ownership. Instead, it suggests something much more specific. China may simply want to influence how gold is traded. That's a completely different objective. Many analysts believe the recent restrictions are less about discouraging investment and more about reducing dependence on highly leveraged paper markets while encouraging greater emphasis on physical ownership. Whether that ultimately becomes the long-term direction remains uncertain, but it's certainly a possibility worth watching. Now let's zoom out even further. For decades, global precious metals pricing has been dominated by financial centers like New York and London. These markets became the global standard because they offered deep liquidity, transparent pricing, and enormous pools of institutional capital. That system has served international markets for generations. But financial leadership has never remained permanent throughout history. As economic power shifts, financial influence often shifts with it. Over the past decade, China has quietly invested billions of dollars into expanding commodity exchanges, improving cross-border payment systems, strengthening settlement networks, and building infrastructure around physical precious metals. Individually, each project may seem relatively small. Together, however, they begin pointing toward a much larger strategic objective: greater financial independence, greater influence over global commodity pricing, stronger resilience against external shocks, and perhaps over time, a larger international role for China's own financial system. Now think back to today's announcement. If speculative paper trading gradually declines while physical trading infrastructure continues expanding, could more attention eventually shift toward actual bullion instead of financial contracts? Some analysts believe that's exactly where things could be heading. Others completely disagree. That's perfectly normal because healthy markets are built on different opinions. But regardless of which side someone supports, one reality remains impossible to ignore. Major structural changes inside the world's second-largest economy deserve careful attention. History has repeatedly shown that financial revolutions rarely arrive overnight. They usually begin with small policy changes that appear technical or even boring. One new regulation, one banking reform, one settlement system, one reserve strategy. Individually, none of them seem revolutionary. Years later, people often realize they were witnessing the foundation of an entirely new financial system being built piece by piece. Could today's decision eventually become one of those moments? No one knows with certainty. But investors who ignore structural changes simply because they don't create immediate headlines often miss the biggest stories before everyone else finally notices them. There's another lesson history teaches us that many investors overlook. Major monetary changes almost never happen all at once. Instead, they unfold quietly through a series of small decisions. A new regulation appears. A payment network expands. banks adjust their policies, reserve strategies evolve. One change alone may seem insignificant, but together they can gradually reshape the financial landscape. Whether China's latest move ultimately becomes a turning point or simply a precautionary measure remains impossible to know today. But experienced investors understand that technical policy changes often reveal much bigger trends beneath the surface. Financial markets have always been built on one essential ingredient: confidence. Confidence in currencies, confidence in banks, confidence in governments, confidence in settlement systems. Once that confidence begins to shift, capital eventually follows. It rarely happens overnight. Money usually moves slowly at first, then much faster once broader trends become obvious. That's why professional investors spend so much time watching institutional behavior instead of reacting to daily headlines. They ask different questions. What are central banks buying? How are regulators changing financial rules? Where is physical capital flowing? Which countries are investing in new financial infrastructure? These signals often reveal far more about the future than the price movement of a single trading session. Right now, many of those indicators continue pointing toward growing interest in tangible reserve assets. That doesn't mean paper assets are suddenly disappearing. It doesn't mean the US dollar is about to lose its global role tomorrow. The dollar remains the world's dominant reserve currency, supported by deep financial markets and unmatched liquidity. But diversification should never be confused with replacement. Governments and institutions can reduce dependence on a single asset while continuing to rely on it for many years to come. That's exactly how financial systems usually evolve, not through sudden revolutions, but through gradual adjustments. And perhaps that's the biggest takeaway from today's story. China's banking restrictions may ultimately prove to be nothing more than a risk management decision. Or they could become one piece of a much larger transformation that has been developing quietly for years. Only time will provide the answer. What we do know is that the global monetary system is becoming more competitive, more diversified, and increasingly multipolar. New financial centers are emerging, payment systems are expanding, reserve strategies are changing, and countries continue searching for greater flexibility in an uncertain world. For investors, that creates both challenges and opportunities. The people who consistently stay ahead of major market shifts usually aren't the ones chasing every daily price swing. They're the ones paying attention to structural changes before they become front-page news. That's exactly why this discussion goes far beyond the price of gold. It's really about understanding where confidence is moving, how financial power is evolving, and what those changes could eventually mean for investors around the world. As these trends continue unfolding, one question becomes increasingly important. If China keeps strengthening its physical gold infrastructure while central banks continue accumulating bullion, how will the rest of the world respond? Will existing financial powers simply maintain the current system, or will they introduce new strategies to reinforce confidence in their own currencies and markets? No one has a definitive answer yet. But history has shown that whenever the global financial system begins to evolve, the biggest opportunities often appear long before the majority of investors recognize what's happening. That's why paying attention today could make all the difference tomorrow. If you found this analysis valuable, make sure to subscribe to Ag John Silver Update for more in-depth coverage of gold, silver, central banks, and the global economy. The biggest financial stories are often the ones hiding beneath the headlines, and we'll continue breaking them down so you can stay informed before the crowd catches on.